All right. Welcome, everybody, to the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week.
Week.
Today, the property we're talking about is a new construction townhome with over 7% expected ROI. It will generate positive monthly cash flow. It's going to have a 2 to 3 year signed lease with a new resident in place ready for you. And we can't wait to tell you all about it.
Thank you, buddy. Thanks for buttering me up there.
Well, you know what? We're just starting to get the buttering going because right now we are live on Facebook to butter up Gregg for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the
Week.
I'm your host, Pablo Gonzalez. With me, as always, the man that I like to call GC because he's got the genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name was born to be Gregg Cohen. Say hello, Gregg.
Hello, everyone. Great to be with you. Can't wait for the POT dubs.
Oh, man, I feel some renewed energy right now with like the Zoom thing working. We're back on track. We got our family in the house. You know, if you are here to learn about rental income property investing, you are in the right place. If you're here to learn about the best type of property management for rental income property investors, you're in the right place. And if you're just a real estate professional looking for an edge in the Jacksonville market and maybe some opportunities for you and your clients, you're in the right place. After this place, the next place to go, place is chatwithjwb.com. And right now it's time for, you know what it is, GC, the roll call. You ready, buddy?
Let's do it.
All right. Put in where you're at and who you are and check in with us in the chat because it is roll call time. John Henning, good afternoon to you. Nadeem Shah, good morning to you in California. Jen Filson, hey, JWB family. Hey, family to you, Jen Filson. It's good to have you here in Jacksonville and hanging out with you tomorrow. Shelly Johnson, greetings from B-Town, Bradenton. Welcome back, Shelly. Good to have you. Who else is in the house? Leo, good morning to you in California, my friend. Bill Shields, buenas tardes, amigos. Buenas tardes, Bill Shields, or Guillermo Shields, if you really want to get technical. Good to have the family in the house. Good to have our usual crew here for the Thursday edition. This is the one that is really all about the audience-generated questions and answers and just having a high-level conversation about what a property looks like, where it pays you from, how to analyze it, all that good stuff. We want the questions rolling in. 2 ways to interact. One is in the chat, which is already happening. Little trick to the chat. It's defaulted only to talk to GC and I. And if you want everybody else to see it, you got to change it to everyone. So like John Henning, when you checked in with us, we only saw it and I want everybody else to see it. So change that to everybody in that little blue box. And second is if you want the question answered on the show, you want me to ask GC, pick his genius brain, then pop open the Q&A and throw the question in there. And that's really just to help me with my limited abilities of keeping track of multiple conversations at once. It just stays there for me. Lee Bishop is in the house. Good afternoon, Lee Bishop. Happy to have you back, buddy. And I'm ready to get into it. GC, you ready for this?
Yeah. Can I put in another request here? We've been trying to expand the reach of the show a little bit. So you guys are seeing me looking down at my phone here. One thing for all of our friends here, I know you guys show up every single week. If you guys wouldn't mind, and if you guys are on Facebook on your phones, if you guys wouldn't mind going to the JWB company Facebook page and sharing this show. It'll go out to all your friends and your family on your networks and whatnot. So you just go to the company's page. Now, I'm not talking about the group here. I'm talking about the company's page. This is where it goes live. And you can just find that by going to facebook.com/cashflowproperties, facebook.com/cashflowproperties. You go there, you'll find the live stream of what we're doing here and just share that with your networks. That would be awesome. And we can have more friends join the fun.
That would be awesome. And there's something else that I want you to do, but I'm going to give you some time to do that. And it's to download the sheet so you can play along. But why don't you go ahead and share? In the meantime, GC, we're about to look at a townhome, man. I don't think we've looked at a lot of townhomes. Why don't you why don't you tell me a little bit about rental property investing when it comes to townhomes? What does the not your average investor need to consider when they're looking at a townhome versus a single family residence versus multifamily? Talk to me about it.
Need to consider the same things that we talk about, show in and show out. When you're talking about investing in rental properties, I have fallen in love with this asset class, right? 15 years ago, it made me leave what I thought was my dream job in corporate America at that point, completely quit that and jump into this because I understood two parts to this. In rental properties, it's about risk mitigation, and then it's about the ability to earn outsized returns, above average returns on investment. So we're going to talk about what to look at on townhomes. There's no way that I'm going to deviate from anything when it comes to, risk mitigation and how to earn above average returns. And the way that you do that for a townhome is the same way you do that for a single family detached house, right? A townhome is a single family attached house. So we're going to look at the same thing when it comes to risk mitigation. I'm talking about positive cash flow, right? That mitigates risk. Ask me how I know that. Well, since you asked, I'll tell you. It's because I was investing in 2006 and I put all of my lifetime earnings, which weren't much at that point, plus probably another lifetime's earnings in debt out there to buy 40 rental properties. And I was there when the market crashed 35% in prices. And I was there to witness how strong positive cash flows were throughout the Great Recession. So I know about risk mitigation. Risk mitigation is one of the reasons I love this asset class, right? You have that positive monthly cash flow coming in. And then we're going to talk about all 5 profit centers, the 5 profit centers, not just positive cash flow. There's 4 other ones, and they help you earn above average returns on investment. So if you can give me something that has risk mitigation and I can earn more in returns than most other asset classes, I'm in, and you should be too.
Sounds good, man. I was kind of interacting with everybody in the chat here. So truth be told, I was distracted. I was biting my lip and chatting, having Lee call me out on it. I like it. I got a question for you. What's the difference between townhomes and multifamily when you are thinking about a rental property investment?
So, both can be great, right? And again, it comes back to the same criteria we're looking for: risk mitigation and then above average returns. When we're talking about multifamily, the reason that you don't see a whole lot of multifamily, actually, before I go there, let's just define what it is, right? Multifamily, you're talking about duplexes, triplexes, quads, right? And a quad be 4 units under the same roof, but there's one owner of that building, right? They own that entire quadruplex. And so when you own that one asset that has 4 units in it, then there's benefits, right? You have 4 income streams under that one roof instead of 1 income stream. So it helps to diversify. You have a tenant that leaves, you still have 3 other ones paying. It also helps to mitigate risk of maintenance cost. You only have 1 roof. You don't have 4 roofs that can go bad. You have 1 roof that can go bad. And so you get some economies of scale there as well. So there's a lot of benefits there. And now if I compare that to a townhouse, the same benefits that I was talking about there are there for a townhouse. A townhouse is 1 unit that may have 3 or 4 or 5 or 6 attached to it, all under 1 roof. So it might be, let's call it a 4-unit townhouse building, but that is 4 units. You could have 4 individual owners, or you could have 1 owner that owns all 4 units and could decide to do different things with those units. So let's compare it to multifamily when we're talking about diversification of income, risk mitigation there. If you bought that 4-unit townhouse, you bought all 4 units, you're going to have 4 residents. If 1 would leave, you'd still have 3 that are paying and would cover the monthly mortgage payments. You have 1 roof still. You have 4 units that you each own. You own each of them individually, but it's all under 1 roof still. So the same economies of scale of risk mitigation of repairs costs, right? You only have 1 roof instead of 4 roofs. So the same way to look at it for multifamily versus a townhouse here. The thing about it that's different though is multifamily has a lot more restrictions. It does not have as much flexibility when it comes to disposition of the asset. selling the asset is what I mean, or refinancing the asset. Because if you own multifamily, it's all or nothing. If you own a quadruplex, you have to sell that quadruplex, which means selling all 4 units, or you have to refinance that quadruplex, which means refinancing all 4 units at the same time. Flexibility is huge in single family investing. In townhouses, you have that flexibility. So you get all the advantages. You have additional flexibility when it comes to single family townhomes, because as I mentioned, again, it's one roof. There's 4 units underneath those, and those are 4 individual properties that you own. So if you wanted to sell one of them and keep 3, you do that. If you wanted to sell 2, 3, if you want to sell all 4, you could. If you wanted to refinance one, but not refinance the others, you could do that. So you have this incredible flexibility that not a lot of people think of. You know, I get asked all the time about multifamilies. I don't know if I've ever had somebody that came to me and was like, hey, Greg, I really, really, really want to invest in townhomes. And I don't know why. Right? They are literally almost exactly the same as multifamilies. There's one downside to that flexibility, though, on the townhouse to point out. So your most advantageous lending as a borrower is going to be when you have 10 or less loans on your credit. And there's strategies to do a little bit more than that, but let's just keep it simple, right? So 10 loans on your credit will get you the best terms for Fannie Mae financing. And if you have a quadruplex and you buy that with financing, that's 1 loan on your credit. If you buy 4 townhomes, that would be 4 loans on your credit. So with proper planning, as I mentioned, we can plan to make sure that you get more than 10 loans on your credit. Talk to my team about this if you're interested on how to do that. We can absolutely help you do that. But that would show up as 4 loans on your credit, and then that could make your advantageous financing be less available for you in the future.
Nailed it, GC. And, you know, I want to encourage everybody right now, go to jwbinventory.com, download the spreadsheet that we're about to get into, right? We're about to get into 2803 Hidden Haven Road. And trust me, it's a haven. And download that sheet so you can tinker around with it at home while we're doing it. I want to say hello to Carl Thompson, who's checking in a little bit late. I want to say hello to Drew Barnhill, who's checking in from his phone on his way down from Atlanta to hang out with us at our networker tomorrow. There was somebody else that checked in, Scott Belote, the famous Scott Belote, who's been in past episodes. Sean Fletcher is in the house as well. Good to see you, Sean, as well. And Casey is asking for us to get into the property sheet as soon as possible. That link, Jen, if you can put it in the chat, is jwbinventory.com. And a howdy to Greg Stone before we get going. All right, let's magically whisk us all away here to 2803 Hidden Haven. Is it showing, or did I just do an effect for nothing?
You totally did that for nothing. I'm saying all of your desktop and all those nice pictures that you had on there. Who keeps such a nice desktop with all the pictures of their friends right on there, Pablo?
You know, it's I love my friends. I love them. All right, here we go. We're in 2803 Hidden Haven Road. As you can see in the picture, it is a beautiful little townhome right here attached to other townhomes. Purchase price, and this is one of the perks of the townhome, right? It's $195K in new construction.
Hey, bud, before you go through that, let me ask you to zoom in there specifically on what you're talking about, because it's kind of blurry for all of us that are, you know, getting older in years and
all right,
all that
man.
good stuff. Solve my problem right there.
I got to see geriatric case GC. All right, so it's $195K purchase price right here. 3-bedroom, 2.5 bathroom. It's going to have a 2 or 3 year lease for $1,375 a month in place. And Casey, this one is for you, buddy. You wanted to talk about the cash flow. You wanted to talk about the ROI. This is what you come to this asset class for. It is $123 total monthly cash flow under conventional financing, and an estimated conventional financing total ROI of 7.33%. GC, you want to tell us what this $123 in total monthly cash flow represent?
Yeah, let's go back to the very first question you asked me here, right? Why should we be investing in rental properties, whether those are single family attached, better known as townhomes, or not? It comes down to 2 things. It comes down to risk mitigation, and then of course we'll talk about how to earn above average returns on investment. When you're looking at this total monthly cash flow number of $123, what that should speak to you is risk mitigation. That's your risk mitigation, because the best way to win in rental properties is to be in the game for a full market cycle. If you're in the game for a full market cycle, which is known to be between 10 to 20 years, it's a long time. It's a long time. Each month, if you have to pay money out on this asset, if you're cash flow negative on this asset, and you start to pile up 3, 5, 10, 100 rental property, 300 rental properties, like I have over 300, you better make sure that you're cash flow positive every single month, right? And I don't get caught up whether it's $100 positive, $150 positive. If you're paying attention and you're choosing a property or a provider or a market because of $25 here or $25 there of positive cash flow, you're missing the mark, right? Positive cash flow is there to help you stay in the game for a full market cycle, but your biggest returns on investment come from the 5 profit centers, and positive cash flow is only one of those profit centers. So that's a big picture. On a more granular level, the way that you get to that estimated cash flow of $123 a month, that's what a normal month is for this rental property. If you were to purchase this property on a normal month, which means that it's rented, which is the vast majority of the time, with you as a client of JWB, then you're going to see this. You're going to see your rental income. We're going to take out your principal, your interest payments, your property taxes, your insurance costs, which happen every single month, can't avoid them. And we're going to take out your property management fees, which happen every single month when the house is rented. You don't want to avoid that. And then what's left over on a normal month is this $123 a month in positive cash flow.
Excellent. A couple of things I want to hit here, right? So that is the typical monthly experience, right? So that's what you get. That's what, you're going to get on most months, except for when somebody moves out, or there's like a one-time expense, whatever, right? Couple of things that are going on in the chat right now. Damien, you're only talking to us, by the way. If you want everybody else to see it, you got to change to everyone. He said I could be wrong, but JWB currently doesn't allow more than one purchase at a time unless you're a new investor. That's changed, right, GC?
Yes, that has definitely changed. It's 3 properties now is the limit. We changed that, probably maybe 2 months ago. And that was a reflection of the incredible amount of new construction inventory that finally was released from the building department. We had significant backups there. So we did have to go down to 1 property per purchase for a while there. But yeah, we're back up to 3. And the new construction assets are continuing to flow. We do have inventory here in Jacksonville with JWB, and that's just not normal in this market. So yeah, we're ready. We're ready to help you build your plan even faster.
There you go. And he came to that because of a response Carl Thompson was asking in the chat, which is, if I were to buy the 4 units at once in a townhome, would I get a little bit of a discount on the total?
It's a great question. The answer would be no. All the assets are priced at market value. And so as just as a regular experience for most turnkey companies out there, you're going to pay market value for the property. They're not going to ask you to pay more, but you're not going to get a discount to market value. If you want a discount to market value, you typically need to be an active investor. You need to go out there, pound the payment, put in lots of offers, get rejected, and hopefully you could find a discount to market value. But this asset is geared more towards the passive investors. We can kind of serve it up for you on the silver platter.
Serve it up. All right. So speaking of serving things up, Casey, when he was asking that he wanted to see the property thing, he mentioned that he wants to see the cash flow, right? So I asked him in the chat, Casey, where does cash flow rank for you when it comes to the 5 profit centers? And he wasn't really sure kind of what I meant there. And I figured I could just save it for you to explain, right? Why don't you explain the 5 profit centers, and then let's talk about this total ROI right now. But quickly go through the 5 profit centers, and then I'll ask you the ROI question. How about
Love it.
that?
And Casey, thanks so much for being so interactive in the show. And I mean, this is great. I can't even keep up with the chats, all these great questions and thoughts, and everybody helping each other here. This is what the show's about. So thank you so much. I love talking about the 5 profit centers. I could talk forever for them about them. So the 5 profit centers, the first one that you're probably thinking of is positive cash flow. And what I find is most investors pay the most attention to positive cash flow because it's easy to calculate positive cash flow. And it's here and now, and it's what rent is collected minus the expenses on a normal monthly basis. So that's one of them. You also have principal pay down. This is a wonderful hidden benefit. This is when your resident is paying your rent for you, And part of that rent is going to pay the mortgage payment. And a part of that mortgage payment is your principal. So your resident is paying your loan down for you. And you don't see this in your bank account every single month, but ask me how I know. If you own properties for 10 years, 15 years, you wake up, you look down and you're like, wow, I had $60,000 loan on that property. And guess what? I don't owe anything more on it, right? That's not so hidden there anymore, right? Then you're a big believer in it. And so that principal pay down is the second profit center. You also have tax savings. Tax savings comes from this wonderful asset class and the tax advantages you get. Everybody on this call, everybody investor can get, everybody who's an investor in real estate and single family rental properties gets certain tax advantages that you just don't get in other asset classes, which help you defer the taxes you would have to pay on income, on rental income. And there's even strategies, of course, to defer taxes on the sale of your property. So tax savings is another hidden benefit nobody pays attention to. Not nobody. Not enough people pay attention to it. If you're on the Not Your Average Investor show, hopefully you're paying attention to it. But that's another benefit that you need to take into account. The fourth one is home price appreciation. And this is the big one, right? Home price appreciation, when you look after holding on to properties for a full market cycle, 10 to 20 years, like I have and continue to do, you're going to look back and the biggest contributor to your return on investment will not be cash flow. It will not be tax savings. It will not be principal pay down. It will not be inflation hedging, which is the fifth one. It will be home price appreciation by a large margin. And the key to home price appreciation is you have to be in the game for a full market cycle to count on it. Think about what people mean when they say real estate is cyclical. That means that home prices tend to revert to the norm. If there's a normal appreciation rate, give it long enough, give it a 10 to 20 year cycle, and you're going to find that on average, year over year, you take the highs, maybe there's some stagnant growth. There's usually not a lot of dips. We have seen that, but you take the average of that and you're going to see that average appreciation rate is typically what it was for the previous 30 years. You just have to be in the game for a full market cycle. If you are, and you use smart debt to your advantage, your returns on investment will be largely comprised of your home price appreciation. Most people just don't have that long-term view. They don't know how to analyze home price appreciation. They don't realize it's cyclical, right? You can't be in for 1 year, 2 years, 3 years and count on home price appreciation. You got to be in for 10 or 20. So that is the biggest profit center if you know how to use it effectively, home price appreciation. And the fifth one is inflation hedging. This is a bigger and bigger topic now than it ever has been. It is definitely a forgotten profit center. Inflation hedging just means you're investing in a hard asset. And as inflation happens, what history has proven to us is that as inflation happens, the rents and the home prices tend to go up with a rate that's sort of normal to inflation, right? We think about inflation being, call it 3% or maybe 4%. Historically, those are the numbers that people use. Well, guess what? Rents and prices tend to go up about that same amount. And it makes sense because as the cost of materials tends to go up and the income that you earn tends to go up as a worker on your active income, the rents tend to go up in lockstep. The prices tend to go up. So you're hedged against inflation because you're investing in a hard asset. And then the way to really win with inflation hedging is to take a hard asset, which is going to tend to go up in prices, like we just talked about, and put smart debt on it. Because you know the thing that isn't protected against inflation is debt. What I mean there is that your income goes up, right? Because of inflation, we all earn more over the years, right? Holding everything else constant because there's more money supply. Well, the debt still stays the same. If you had $1,000 to pay every single month on your mortgage payment, your income tends to go up. Well, your debt's still the same. So it gets easier and easier to pay down that debt over time. That's how you really, really win against inflation. So there's the 5 profit centers.
Good breakdown, man. Dean Curry has a question to that. How do the 5 profit centers work when using non-recourse lending? Is there a difference per profit center? Like I know, for example, tax savings isn't the same with non-recourse lending because you're divided. What else is out there? Can you talk through that?
Yeah, absolutely. And non-recourse lending is a different type of loan. Many of us probably haven't heard about that. If you're new to the show, you may have not heard that term. Non-recourse lending is a different type of loan where the bank can't have recourse against you. A normal loan, when you go to Bank of America or Truist or whatever bank, Wells Fargo, and you go and get a loan, they're going to have a recourse loan. It's not called a recourse loan, but that's what it is. And that means that if you don't make the payments, not only are they going to take the house back from you, they are also going to have recourse against your credit, and you won't be able to buy a house for 7 years. All right. A non-recourse loan means if you don't pay the bank on time, they are going to take the property, but there's no credit score that they're going to go after. They don't have that recourse against your credit score. So that's a non-recourse loan. So you can imagine that would increase the risk profile, and non-recourse loans can be a great asset for the right type of investor. If you're curious as to whether or not this can be the right thing for you, reach out to my team, schedule a call. It's a really personalized decision. But there's going to be higher rates and higher terms. And generally, this works for those loans where you can't possibly give a credit score. You can't possibly give your social security number. And what I'm hinting at there is these are retirement accounts that you're buying properties in that can actually get loans. But your retirement account does not have a credit score, does not have a social security number. You do, but when you're buying in your retirement account has to purchase that property, and it does not. So the only type of loan is a non-recourse loan for a retirement account. So the question is, how do the 5 profit centers work there? Well, if you're buying in a retirement account, and you get a non-recourse loan, what you're going to see is lower cash flows, right? If we're looking at the screen here, and you see that line where it says estimated non-recourse financing total monthly cash flow of $85, right? That's going to be closer to break even, right? So on a monthly basis, your cash flow is going to be lower. So how this relates to all 5 of your profit centers, you'll still have that profit center of monthly positive cash flow, but it'll be lower, right? Let's go to the next one, principal pay down. Well, you do have the principal pay down component, right? Because your resident is paying that loan, they're paying you the rent. That rent is going to pay the loan down for you, and a portion of the loan is going to be principal. So you still get the principal pay down. In fact, you get higher amount of principal pay down because your loan balance, the terms of the loan are a little bit different. Generally, it's a 20-year loan, so you pay it off quicker and all that other good stuff. So principal pay down is probably a little bit higher. Tax savings. In your retirement account, you already get these tax savings, depending on which type of retirement account. If it's a Roth account, then you don't pay taxes on the gains. If it's a traditional retirement account, then your taxes are deferred. But either way, you get these incredible tax advantages by being in that retirement account. So you don't get additional tax savings for being in real estate, right? You already get them because you're in that retirement account. The IRS doesn't allow you to depreciate again on that. So your tax savings component specifically for being in this asset class and a non-recourse loan, you can just kind of do away with it. You already get it. You don't get additional ones because you're in rental properties there. Home price appreciation, again, the same theory applies, right? You need to be in the game long term. You can count on that same amount of home price appreciation given a full market cycle. In Jacksonville, it's 4.3% is what the market has shown us over the last 30 years on average. That's not 4.3% from start to finish. That's 4.3% year over year over year over year. The difference, though, as to how it affects your profit centers, Dean, is that when you're taking out a non-recourse loan, you have to put 50% down. They don't let you put 20% down or 25% down because these loans are more risky to them. They make you put more skin in the game. So they make you put 50% down. If the market goes up 4% a year and you put 50% down, that's an 8% return on investment from the appreciation. You put half the money in, it went up 4%, right? You earned 8%. If you were to use conventional financing and you could put 20% down on that property that appreciates 4% a year, it would actually be a 20% return on investment from the appreciation because you only put 20% down and you'd multiply 4% times 5, get you to 20%. So as it relates to the profit centers, your effects on your total return on investment from home price appreciation for a non-recourse loan will be lower, still going to be the majority of your returns given a full market cycle. It will just be lower than if you were able to secure financing for 20% down or 25% down.
There you go.
There you go.
Yeah.
And then inflation hedging, same thing.
You're
protected against rents going up and prices and all that good stuff. So because you're in a hard asset.
Got it. So, all right. So we talked about the cash flow, right? Like this kind of started with Casey asked, he wanted to put the cash flows up there. I asked him about the 5 profit centers, right? So we explained the 5 profit centers. We talked about the monthly cash flow. That's one of the 5 profit centers. So I'm hoping that, we explained that the biggest profit center possible is home price appreciation, and you can count on it if you're in it for a long term. And Jacksonville happens to be the best positive monthly cash flow and high price appreciation market, right?
Mm-hmm.
Real quick, before I get you to explain the total ROI here and how that fits into the equation, for those of us concerned with cash flow, Lee is asking an interesting question. Is this the new rate or the old rate of rent? You want to explain why he's asking that?
Lee, I love our group. Lee, thank you so much for being here each and every week, brother. You're just a huge asset to this community. And Lee was there probably for the client only call that we had on Monday of last week, and also for the real estate market update that we had on the show here on Tuesday, where I was, and he was also there for the show on Tuesday where we did a case study of the rate that somebody saw on an evaluation versus what actually played out, right? The rent rate that we told them to expect versus what has actually transpired for that investor. So to get to the point that Lee's making here, we're very conservative with our rents. We do this on purpose. And it is very common for us to hit that rent number and sometimes come a little bit above it. I don't remember the last time we were under for a rent number. So the numbers that we've actually run over the last 2 months of closings that have happened, our actual rents have been 11.6% higher than the evaluation stated for that owner. So picture this, you're thinking about buying your very first turnkey rental property where you come to JWB, we hit it off, you're excited, you buy this property and you expect, was that $1,375 in rent on this one there, Pablo, if you want to go a little bit to the left there?
We'll go a little to the left.
You buy it at $1,375, okay? Meaning that's the rent that you expect. When you get to the closing table, JWB calls you up and said, hey, we got this thing closed. I'm super excited. Guess what? That $1,375 rent is not actually what happened, right? The rent that you're going to get is, I'm just going to add 11% to $1,375 is, what is that? $150 on top of that. So 1,375 times 1.11 to 1526. Right now, type in 1526 there, Pablo.
Don't mind if I do.
Sorry, don't mean to order you around. I'm just so excited, man.
It's all right, man. I'm here to serve, bro. All right, so we put in 1526. Check this out.
Yeah, that $123 in cash flow in reality is $259. That return on investment has jumped up, what, 2.5, 3 points there.
Yep.
And this is a real thing. That's actually documented. That on average, 11.6% higher over the last 60 days. Might be one of the last times you guys hear me talk about this because I, throughout my history, have tried to under-promise and over-deliver and use that as a moment just to, really wow clients who come on board. So if everybody in the show here can just keep this as our little secret for new people who come on board, but it's reality. This is why clients come back to us and actually enjoy owning rental properties versus the norm out there, which is people are frustrated and underwhelmed with rental properties.
There you go, man. So I put it back to the original numbers right now, right? Just for the sake of the rest of this call, and really, really cool little feature there, right? So yeah, guys, it's a little secret. It's a little secret of the pros out here, right? So GC, we've kind of flirted around this the whole time. We've talked about cash flow plenty. Why don't you tell me more about this total ROI and what the difference is between that and cash flow?
Yeah, your total return on investment is the second part of this, right? When you go to buy a rental property, first make sure that it pays for itself every single month. That's positive cash flow. Next, now that you've mitigated your risk. Now let's see how much return on investment we can get from this thing. That's how my mind works. Am I making sure I'm paying for itself every single month? Okay, cool. Now that I got that squared away, now what's my profit potential? What's my potential return on investment? So when you're talking about your potential return on investment, you need to be factoring in those profit centers, right? So your total return on investment is going to take into account the positive cash flow that we talked about. It's also going to include additional profit centers, and it's also going to include additional costs that the monthly cash flow doesn't take into account because they don't happen every single month. So some of those costs would be maintenance costs and vacancy costs. As you can see below there, we estimate 3% for vacancy costs and 4% for maintenance costs. That's a percentage of the rents each year. And so we tell you that's going to happen on average each year for your ownership of this asset. But that doesn't mean it's going to happen day one. In fact, in your first year ownership, first few years, it's relatively late, right? But over time, that's what you need to plan for. And then there's other things, right? There's tenant placement fees. The tenant placement fee is the fee that your property management team is going to earn when they put a tenant in your home for you. You want this fee because you need a tenant in your home. Some turnkey providers don't include those on their evaluations, which I don't understand, but we do. And then there's other fees too. Like there's closing costs that, we don't earn closing costs from you, but somebody does, right? The bank does, the title company does. So there's those other things that are taken into account on the cost side when it comes to your total return on investment. Now on the positive side, we're going to look at principal pay down. We have that calculated for you. We know what that effect is. We have the tax savings component, assuming you're buying with conventional financing, right? Then you're going to receive tax savings because you're in this asset class. And if you're in non-recourse, we take that out of the equation. That's not included. And then we're going to include home price appreciation here in a second there, Pablo, right? Right now, we don't have it included. We have it at a 0% appreciation rate, but yeah, I'm teeing you up there, Pablo. Take it away.
Let's do it, man. I mean, you already said it, right? You have to be in for a full market cycle. That's why you put it in for 0% because you want to control the deal. And you don't know if people are going to hold for a full market cycle. But if you do hold for a full market cycle, you can bank on the historical home price appreciation, which is 4.3%. And when we do that, it is my favorite trick to do on the show. Pow. So jumps up 16% extra for the conventional total ROI. And you kind of explained it earlier, but now with the visual aid, maybe it's a little more powerful if you want to go into that, GC.
I hope it's powerful. This is what was powerful enough for me to quit the job that I had worked really hard to get and jump full feet into buying, rental properties and eventually building a business based on it. It's because if you master smart debt, then you can invest in an asset that pays for itself every single month and still can earn over a 20% total return on investment. You just don't get that in other asset classes, right? Usually you have to decide between one or the other. You can get recurring income coming in bonds, but can you earn 20% in bonds? No, right? You can earn 20% in the stock market sometimes. You have a lot of variability though, right? And you don't get monthly recurring income in the stock market to this degree. So in essence, this is what I love about rental properties. And the reason that it shot up to 23%, it only takes 4% of appreciation, assuming you're putting 25% down to make your numbers shoot up to over 20% total return on investment. And that's because, again, your return on investment is a calculation based on how much money you have in the deal, how much of your own money you have in the deal, right? If you're investing in an asset that goes up just 4% a year, which is historically what we've done in Jacksonville on average since 1991, if it just goes up 4%, right? Not even the 9% that it's gone up since 2012 or the 15% that it's gone up over the last year. I'm just talking about 4%. If it goes up 4%, and you put 25% down, that's a 16% return on investment from the home price appreciation only. And then you tack on the positive cash flow, the principal pay down, the tax savings, and now you're up over 22%, close to 23% total return on investment.
Leverage, baby, right? Using other people's money to leverage your money. And I've heard that you can only get 20% in bonds if you're James Bonds.
Shaken, not stirred.
came up with that. Just testing out new material for my set. All right, here we go. Let's get into some Q&A here. Greg Stone asks, great first name, Greg. Just throwing it out there. Greg Stone has a question: are the HOA fees taken into account already in this cash flow forecast?
Yes, absolutely, Pablo. If you want to hang a Louis there and go over to the other side of the document there, next to the there we go. Yeah, you'll see line what is that, line
right
28.
Here, 28.
There you go. $1,500 a year for your HOA dues. So this is the deal about townhomes, right? What you're going to find with townhomes is that your rent to price ratio is going to be better for townhomes. Okay, I'm going to say that again. Your rent to price ratio is going to be better for townhomes than if it was a single family detached house. What I mean by that is, look at your rent, $1,375 over $195,000 purchase price. All right. What's that? Let's see. $1,375 over $195,000. That's a 0.7% rent to price ratio. Well, a normal property that rents for, call it $1,375, is probably priced at $230 for a single family detached house. All right. So we were at 0.7% for a rent to price ratio for townhomes, but you take that $1,375 divided by 230,000, and that's a 0.6% rent to price ratio. So townhomes are going to have a better rent to price ratio than detached houses. However, townhomes are homes.
Go ahead.
Oh, man. Townhomes are also going to have an additional cost that single family detached houses typically do not, and that is in the form of HOA dues. And so you get a better rent to price ratio, but you give some of that back in your annual HOA dues. And at the end of the day, we're still able to produce those, call it 7% estimated returns on investment for townhomes or single family detached, not including home price appreciation.
Got it. So that's Townhome, spelled TOWNHOWM for those following at home. All right, cool.
I couldn't decide if I wanted to say houses or homes.
I saw what was going on in your head, buddy. All right.
Oh,
Nadeem Shah has a question. Is the rent higher when it's a new build property than older homes? And then does that mean that the cash flow is more?
Yeah. Answer to that is yes. I mean, everybody should put themselves in their own shoes as a renter in this case, right? If you went to go and rent a home that was brand new versus a home that was not brand new, would you pay $25, $50 a month more? I don't know, $100 depending on where you're renting, right? Would you pay a premium? I would, right? And that's what residents decide as well. So that's wonderful for you as an owner of rental properties because you're able to get premium rents, right? They are the rents for that market, but they're at the height of that market, which is where you want to be. You don't want to be like way outside the market because that's not sustainable. You need one renter who's going to pay this, right? But what I'm talking about is premium rents within that dynamic for that market, for that neighborhood. And you're able to get them with new home construction.
Yeah. Does that new home rent drop lower after the first tenant moves out since it's not a new home anymore?
No, it doesn't, especially not with the way that rents are rising right now, right? We pulled the data on rents rising here in Jacksonville with our own internal data here, and rents have risen year over year 8% for our inventory. And keep in mind here, we're not signing 1-year leases. We have that smaller section of the renting population who's going to sign a 2 or a 3-year lease, and we're still seeing 8% rent increases year over year, and that's on older homes, that's on new construction, right? We're seeing it across the board. So no. And even if you weren't in an environment where rents are raising 8%, like for example, I mean, we've been doing this for 15 years. We have never seen rent decreases just because it went from a new construction status to not new construction. I mean, geez, it might be 3 years old and there's still a premium to be had for that. So it's a great question. I've never had that one on the show yet, Pablo. So yeah, it's a good one, but no, we don't see that.
I popped that right up to the top because I've never seen that before. Here's another one that we don't often see, but I've always been really curious about. And it's from a guest here that I think is from France. The name is Anonymous Attendé. And the question is, How
I think
would
they have townhomes in France too. It's
in
amazing, right?
France,
I hope they
certain
asked a
parts of
question about
France,
townhomes.
certain pounds in the south of France, they have townhomes. So, and then the Mr. Tinde asks, how would directly owning properties be more advantageous than, let's say, investing in syndications or DST as an accredited investor?
Love this. Wonderful question. In fact, Pablo and I, right before the show, were kicking around new show ideas coming up that are just more targeted to the questions that people are asking. And you are validating what Pablo was saying. He's like, man, we need more shows on this topic, that topic. And one of the topics was rental properties versus and direct ownership of the assets versus a syndication, right? When you invest in a syndication, you are investing into a company that is then performing all of the actions of buying, selling, renting for a certain population, a portfolio of homes. Syndications can take many different forms. I'm just describing a single family rental syndication. So how would this compare, right? If you're investing in single family houses as a direct owner, which is what I mean by a turnkey client, right? JWB selling the house to you, you own it, you control it, right? The biggest difference between that and a syndication is lack of control, right? You do not control when you are going to liquidate as a syndication investor. You do not control when you want to refinance as a syndication investor. Typically, your profit potential can be similar. You can definitely earn 20% returns if you are investing with a great syndicator who knows what they're doing. It is certainly possible. And, but there's a couple other differences as well. With direct ownership, you typically get better tax savings. You don't always get to take advantage of the tax savings in a syndication. You have to read the fine print on that. So you might have that in your corner for potential return on investment. And then the other thing is that one of the best things, and the reason that I was able to buy 40 rental properties direct ownership when I was 23 years old, is that you don't need to be an accredited investor to be a direct owner of rental properties, right? The barrier to entry of rental properties is huge, especially in the beginning, right? If I had to wait until I was an accredited investor to buy rental properties, I'd have been waiting a long time to do that, right? I was nowhere near at 23. And so it's the same thing for all of you out there, right? To get into rental properties as a direct owner, you generally need 20% down, which might be something about, call it $50,000 or so for a down payment, which is a lot for some folks. I get it, but it's not the $1 million of net worth that you need to have to be an accredited investor. Generally speaking, almost all single family syndications out there require you to be an accredited investor, which is that you have $1 million of net worth, or you make, I believe, $200,000 a year for the last 3 years. I don't know. Don't quote me on that. You ask your CPA about that. But huge barrier to entry to get into syndications that you just can't do unless you have reached that status.
Yeah, not to mention that you can get into this asset class by finding somebody to lend you 40 and you have 10, and like there's just like an infinite amount of deals of coming up with that 50K, as opposed to this like hard and steady rule of being worth a million or making 200K a year, right?
Absolutely. We could do a whole show on the ways that you can raise capital. If the only thing holding you back from buying your first rental property, your first 3 rental properties is capital, tune into the show every single week, because capital should be the least of the obstacles. Right? I can come up with a million different strategies to help you earn that capital, because I did it at 23 and I didn't have any money. I'd been working for a year and somehow I bought 40 of them. So we can do a show on that for sure.
Who would tune into a show of Gregg talking about a million different ways to raise capital? He will not stop speaking until he reaches 1 million with different ways.
I love it. If we don't,
chat's lighting up, bro. Chat's lighting up.
Donate $1 for every time I reach to JWB Cares, our charity. I don't know. Let's do something like that. We'll figure something out.
Hey man, I have a feeling that they tune in for 7 different ways of raising capital, right? To give you a little break, and maybe we can do that 300,000 times, and we'll get to 2 million. All right, so cool. We got a couple of good ones here on turns, right? So Lee Bishop asks, new tenant placement is about a month fee, but a turn on tenants can be as much as $4K, right? You want to explain that?
I mean, I'll tell you, I mean, I've been investing for 15 years. I have 300 rental properties. I manage over 4,100 rental properties. I'll tell you, it can be more than 4K. I mean, you should know that going in as a rental property investor, right? I mean, on average, your out-of-pocket cost for a turn, which means that when your resident leaves and then we need to put a new resident in there, on average out-of-pocket, it's about $2,500 for a client. But could it be 4,500? Yeah. Could it be 5? Yeah. I mean, I'm a big proponent that in order to get into this asset class, you need to be able to weather the storm emotionally, financially, right? You can have a swing of $5,000 for a property turn. Is it often? No. Does it get balanced out by the times that you have a $500 property turn? Yeah. But it can be a little bit more there. So yeah, on average, $2,500. And that's all built into this maintenance expectation. So that 4% maintenance rate has been taken into account those properties that have turned over the years, right? And the vast majority of your costs are actually going to be from the turn. When the home is rented and it's occupied, you generally have less maintenance items. And, in my opinion, you're just sort of, you're kind of earning more positive cash flow in those moments when the house is rented, and you're stockpiling it, and you're going to give some of it back when the house turns. Like, you need to have that mentality. And on average, again, it's $2,500.
There you go. And Lee says, thanks, Greg, but it'll make the 11% increase in rent worthwhile, brother. I agreed, man. Yeah. So an Anonymous Attendee says, also had this question, said, thank you for the info. Does the sheet include turn costs for every 2 to 3 years? Is that what it is included in this?
Yes, that is a great question. And that is that maintenance rate right there, right? If we were to take out only the maintenance cost that happened during turns, our maintenance percentage would be way low. I don't know what it would be. I haven't run the numbers, but I know that the majority of our costs for maintenance come from a property turn. So if you took that out, the maintenance percentage would be lower. It'd be way lower. It'd be 1%, right? Or making that up, but I think you guys get the point. So that 4% is including properties that have turned that on average have cost the owner $2,500. And then that maintenance cost is included in there. And that's how we are able to give you guys those expectations for maintenance costs.
There you go. And GC question, is it every 2 to 3 years? Isn't your average like 4 point something? Is that what's included here? Or you want to kind of talk through that?
Yeah. Thanks for fact checking me there. Yeah. Our average resident actually stays 54 months. It's 4.5 years, because we sign 2 to 3 year leases, and then 70% of our residents renew. And it all shakes down to an average duration of resident stay of 4.5 years. And so, yeah, as I mentioned, that's including that maintenance rate. Thanks for bringing that up, brother.
You got it. I'm paying attention out here. Speaking of paying attention, it's 1:23. We've got 4 open questions, and ready for rapid fire?
Game on.
Beep, 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 beep. All right. Ty Oladipo asks, welcome back, Ty. Haven't seen you in a while, but good to have you back. Do new homes force the appreciation of existing homes in the vicinity? What would force the appreciation of newer homes?
Generally speaking, Ty's bringing up a good point. If you're in a normal market, right, and you have a preponderance of new construction homes compared to renovated homes, that generally speaking, you would see the new homes push the market forward. And then, because new homes typically sell for a premium, right? Any of us in that same position, if you had a chance to buy a new home versus a renovated home, you'd probably buy the new one and pay a little bit more, right? So generally speaking, new homes tend to push the market. I'll tell you right now, this is a rapidly appreciating market. So now it's like the last sale is pushing the market, whether that's a renovated home or whether that is a new construction home. So in a rapidly appreciating market like we're seeing right now, it's the last home, the effect of new or old construction is less impactful. But he brings up a good point that in a normal market that appreciates at 4% a year in Jacksonville, you would expect the new homes to really kind of set the standard.
Awesome. Damian An has a question. GC mentioned that you get a better rent to price ratio for townhomes, but do they typically lag behind traditional detached homes when it comes to price appreciation?
It's a great question, Damian. Man, we've got such savvy investors here.
That's a good one, man.
Yeah, man, that's a good one. That is really good. Yeah, and I'll just keep pointing back to put yourself in the shoes of a buyer, right? if you have the ability to buy the same home in the same neighborhood and it's attached versus the same home in the same neighborhood that's detached, which would you buy and would you pay a premium for it? The answer is detached, right? It's close. You wouldn't pay like a 50% premium for it, but you might pay a 10% premium for it or whatnot. So yeah, it brings up a really good point that in a normal market, your appreciating homes are typically going to be the detached homes first, and your attached homes tend to follow, because generally speaking, people would prefer a detached home than an attached home. Again, in this market, it's really about what's the most recent sale. So that effect is less minimized. And the bigger thing is that, over the long haul, whether it's detached or attached and what appreciates first or last, I'm a big believer in the full market cycle. And so I wouldn't say that you invest in attached or detached or new construction or renovations because you're trying to gamify the system and make more of a return on investment, right? If you're in for a full market cycle, the theory that has been documented with my own portfolio and with the portfolio of our clients now for over 15 years is that if you're in the game for a full market cycle, you're going to see about what the normal average appreciation rate is, no matter what type of asset.
There you go. All right, Carl Thompson, another good question. Did you need to save that initial 20% to buy your first home, or did you find a different means of financing to buy that property? Well,
I didn't have that money, Carl. I didn't have that money in the beginning. All I needed was a chip and a chair. And I was going to find a way, like Pablo was talking about there, right? No, I didn't have the money to do it. I had just landed my first job at Johnson & Johnson here in Jacksonville. And so what I did was educated myself and networked and got enough confidence up, especially with my business partner, Alex. We put the numbers down and looked at these evaluations just like you guys are looking at today, and felt confident in my first purchase, which was actually a condo in Jacksonville Beach. And I put the business plan together and I went to my dad and I said, "Pops, you want to support your boy? You want to give me a loan here?" And Pop said, "Sure, well, I'm gonna charge you interest." And I said, "Great, you should." We worked out flexible terms with my dad, loaned me the money for the down payment or the first property that I purchased. The plan for us was to purchase that property, live in it for about a year. And we didn't really understand how real estate market worked in 2006. We didn't really understand how to have leading indicators for where pricing was going to go. We had no clue that the market was going to drop 35%, 3 years later. On our fancy spreadsheets, we had anticipated monumental appreciation and that we'd be on a yacht in like a day or whatever we were. So the plan was that we were going to hold on to that one, and then that would be wildly successful after 2 or 3 years, just based on home price appreciation. And that didn't happen. But the beauty was that it was positive cash flow. It was positive cash flow, even though the value went down, still able to pay my dad back, all of that good stuff. And that was the beginning of seeing that and then getting a lot of confidence that this model worked even when the market went down. That risk mitigation, I keep telling you guys, if you know me personally, and can't wait to meet more of you on Friday when we do our live, we're going to get together at Casa Marina here. If you guys get to know me and my team, like, it is risk mitigation first, and then what gains can you make? That's what I have lived as a real estate investor.
Nice, man. You brought up something awesome. Tomorrow we're having our first ever in Jacksonville. So there's already been a Not Your Average Investor Show meetup that was championed. Actually, the first one was in Atlanta, where Jen and her husband Renee met up with Drew, and then they went and had one in Monterey, California without us. But now this is the first one that we get to be a part of. So we're super pumped about it. Tomorrow, Jen is pulling together a group of us in Casa Marina on Jack's Beach, 3:30 to 6:30 p.m. It's an awesome little rooftop overlooking the pier on the beach. Super, super cool in a historic hotel. If you're here, if you're within let's say like a 17-hour drive, I think you should do it.
Totes.
Just throwing it out there. One last question in the Q&A, not really a question, but Anonymous says, I guess I need to do a Paris trip after a Jack's trip. Appreciate the answer on turn costs. We appreciate you, Anonymous. It's always fun to get these questions and do the French accent. This is a great call, man. Really phenomenal questions. We've got a really, really good call coming up on Tuesday. And the theme of that call is learning to wield the secret weapon of real estate investors, AKA the 1031 exchange, which is what Gregg just did in the form of a karate chop. That is the 1031 exchange move. GC, you want to tell us about who's going to join us?
Oh man, we have an incredible guest. You guys have not met Claudia Kiernan from 1031 Exchange, but she is incredible. She has been helping our clients perfect the 1031 process for years now. There's a lot that goes to this. Not only is it just incredible opportunity that I know she's going to help us dissect as far as understanding the tax savings component that can save you tens of thousands, hundreds of thousands of dollars as you build your portfolio through 1031 exchanges. But she's also going to talk about the do's and the don'ts, because I have also seen other investors out there who did not get to work with somebody like Claudia, who tried to get a 1031 going, tried to do it themselves, messed up one document. The money went into their bank account instead of the 1031 account, and the 1031 opportunity is lost. So she is an incredible resource, has a huge responsibility to make sure that these things go well. And I know she's going to be able to bring that fire on Tuesday. It's going to be fun.
That fire. All right, GC. This was a great call, man. Like this, it feels like we finally hit stride again on the Thursday show. Really great questions, some new faces, some familiar faces as usual. This was a lot of fun, man. Like I can't get over the fact that, you know, over 30 people take an hour out of their day on a Thursday to hang out with us and come up with these great questions and allow us to come up with these answers, and that I get to be a part of it, man. So thank you everybody for showing up. GC, I'll give you last call out here.
I'm just super impressed with the quality of the people and the questions that we have. Every week it gets better and better. Thank you guys. You know, I would just love to continue this little kind of community that we've built. It's such a living and breathing thing. I feel it. I think you guys feel it. We're going to feel it on Friday when we're all hanging out together. It's become something that is really important and special to me. And, you know, I just want to continue to grow it with the right group. And I figured the right way to ask, or the right people to ask to grow the group is you all. You know, I'm not interested in growing it with all of these folks out here who are naysayers and think that, you know, that you don't have a positive attitude when it comes to things like this type of opportunity. I mean, I want to surround myself with you people. So if you have a friend or a family member that you would like to be a part of this, I would just love it if you could reach out to them this week and just say, hey, why don't you join the show? All right. And all it needs is an email, right? Send an email. But the link for the show is nyais.com. If you could send that email to one person that you think would get value here and would have a lot of fun, it would mean a lot. So we appreciate you guys, and can't wait to see you guys on Friday. And then next Tuesday is going to be awesome.
Yeah. Just want to give a shout out to Ashley, who joined us for the first time, says she's coming back. Ashley, that's awesome. We love it. So nyais.com. That's notyouraverageinvestorshow.com, nyais.com. Hope you enjoyed it as much as we did, and we will see you on, I hope to see you Friday. If not, we'll see you Tuesday. If not, join us in the Facebook group. You know where to find us. Take care.
See you, everybody.